Welcome to the Explainer. Today, we're jumping right into the hidden math behind a completely fascinating generational paradox. We're going to break down how a generation that's been relentlessly stereotyped as terrible with money, often labeled as lazy or entitled, actually orchestrated the largest wealth transfer in history. We'll explore the specific economic environment that shaped them, and more importantly, the new rules they invented to actually thrive in it. So let's unpack this core paradox right off the bat. To really understand what's going on, we have to look past the avocado toast jokes and those lazy stereotypes. What we're going to uncover today are the entirely new financial habits and mental frameworks this generation developed. And frankly, these are habits that make previous generations deeply uncomfortable, but they make perfect mathematical sense when you actually look at the data. To make sense of this massive shift, let's compare two 32-year-olds, Alex and Jordan. Now, they're dealing with the exact same economic reality. They went to the same college, they have the exact same starting salary of $55,000, and they live in the same city dealing with identical inflated housing and stagnant wages. But, as you'll see, they are operating with entirely different financial rulebooks. Section 1, Defensive Architecture and Income. Let's start with income. According to Bankrate, millennials participate in side hustles significantly more than Gen X or boomers. A massive 44%. Take our avatar Alex, for example. Despite having a perfectly solid $85,000 a year corporate job, Alex puts about 3 hours a day into a $400 a month freelance design gig. Now, Jordan looks at this and thinks, why not just focus on getting promoted at your main job? But Alex is running a totally different equation. What's really telling here is the motivation behind it. This extra work, it isn't driven by some burning entrepreneurial passion or just wanting fun money for the weekends. A staggering 63% are doing it specifically because they're worried their primary income just isn't stable. It's essentially financial anxiety translated into income diversification. You see, Alex watched loyal employees lose absolutely everything in corporate reorgs, walking away with nothing but a tiny severance check. Because of that, Alex built what we call defensive architecture. It's a deliberate, calculated hedge. By building multiple income streams, Alex ensures that their income never suddenly drops to zero if one employer decides to make sudden cuts. And this mindset brilliantly illustrates the new reality of compensation. Data from the Harvard Business Review shows that job hoppers in their 20s and 30s earn approximately 50% more over a 10-year period than those who stay loyal to a single employer. The whole concept of a loyalty premium from the past, it's essentially been erased. The math here absolutely speaks for itself. Jordan plays the traditional corporate ladder game, earning steady 3% annual raises, and is now sitting at $62,000. Alex, on the other hand, hopped jobs 3 times, aggressively negotiating for the true market rate at each jump, and is now making $92,000. Alex optimizes for income trajectory simply because the expected value of corporate loyalty has dropped to near zero. Section 2. The new psychology of spending. So, how does this translate to spending? Well, Jordan spends $1,800 a month on a nicer apartment and accumulates physical goods, which is the traditional marker of success, right? Alex, conversely, rents the cheaper place for $1,200 and lives super frugally on a day-to-day basis, but will happily drop $600 to $800 on a weekend trip or a concert. Older generations might see this as reckless, but Cornell University research actually backs Alex up, showing that experiential purchases generate much more lasting happiness than material things do. But it goes way deeper than just chasing happiness. Alex is operating under what economists call loss aversion amplification. Growing up and watching the 2008 crash, Alex learned the hard way that houses can be foreclosed on and 401ks can be completely wiped out. But the memories of an epic road trip with your best friends, those can literally never be repossessed. It's a calculated psychological hedge against a very volatile world. Section 3. Rethinking debt and housing. Now, this next part sounds completely irrational at first glance. Why in the world would someone carry $8,000 in credit card debt at 22% interest for a freelance business, but flat out refuse to take out a standard 6% car loan? Well, taking on debt for income-generating assets like Alex's freelance laptop is a calculated business investment that pays for itself. Jordan's 6% car loan, however, is just depreciating consumption debt disguised as responsible adult behavior. And that brings us to the ultimate American milestone, buying a house. Jordan just assumes homeownership is always superior, saving $30,000 for a $400,000 house while eating 4 to 6% in annual hidden maintenance costs.
But Alex sits down and runs the strict math for their specific market. Alex concludes that renting for $1,200 and investing the difference at an 8% return actually builds $250,000 to $300,000 more in liquid wealth over a decade, all without being locked into a massive illiquid asset that could lose 30 to 40% of its value, like homes did in 2008.
Section 4. Risk, Savings, and Independence. When it comes to saving, Jordan safely stashes 15% of their income in cash. But this triggers what we call the slow bleed. With traditional savings accounts paying basically nothing and inflation humming along at 3 to 4%, a standard savings account is practically a mathematical guarantee of wealth erosion. Knowing this, Alex saves just 8% in cash and aggressively redirects 12% into riskier assets like real estate crowdfunding. Because Alex doesn't have the luxury of a guaranteed pension, they have to accept short-term volatility just to outpace inflation. We see this exact same risk calculus applied to student loans. Jordan aggressively paid off $45,000 in 6 years for safety and peace of mind, costing roughly $52,000 total. Alex, though, opts for an income-driven repayment plan over 20 years. Looking impartially at the numbers, neither approach is inherently wrong. Jordan optimizes for the safety of having zero debt, while Alex makes a highly complex, calculated bet on income growth over time and the real potential for $20,000 to $30,000 in federal forgiveness. So what's the end game here? Alex isn't aiming for a traditional golf course retirement at 65. Alex is aiming for employment independence. That means reaching a specific investment threshold, like an $800,000 portfolio that generates enough safe withdrawal income so that when combined with freelance work, there's an unbreakable financial floor. The goal is to ensure you never, ever have to accept a bad job offer out of sheer desperation. Achieving this level of independence also means fiercely protecting your time and avoiding unnecessary fees. A Stanford study shows productivity completely tanks after 50 hours a week. Jordan pushes through, working 50-plus hours, but Alex fiercely protects a 45-hour limit, valuing life satisfaction over blind corporate loyalty. On top of that, while Jordan pays a traditional financial advisor $1,500 a year, Alex relies on their own earned skepticism. After watching institutions break their promises, Alex builds independent models, knowing full well that cheap index funds frequently beat out expensive active managers.
Section 5. The Final Score Reveal.
All right, it's time for the final score reveal. After 7 years, Jordan played perfectly by the traditional rules and has a net worth sitting right around $40,000 to $45,000. But Alex's seemingly reckless and often misunderstood path, it has actually generated double that, sitting comfortably between $85,000 and $90,000. And when we project these trajectories out to age 65, the gap becomes absolutely staggering. Jordan is currently on track for about $300,000. Alex is on track for $1.2 to $1.5 million. And remember, Alex achieved this vastly higher trajectory on a smaller starting salary with significantly less institutional stability simply by optimizing for adaptation, income growth, and diversification. I'll leave you with this provocative thought from our source material to chew on today. What economic environment are you actually living in? And are your financial habits matched to that reality or to a world that simply doesn't exist anymore? These new millennial habits aren't random entitlement. They are a brilliantly rational adaptation to a permanently changed world. Evaluating which world you are truly living in might just change your entire financial future. Thanks for joining us for this explainer, and we'll catch you next time.